Hey, this is Jon Johnson and Gabriela, Cernas-Frantz, coming at you with our monthly mortgage market update. This is for April 2022. The exact date is April 16, 2022. A lot of things have happened over the past month in the mortgage market. Yep, so we're going to be going over that. I know a lot of people want to know about rates, so we'll discuss rates. We'll also discuss many different mortgage updates and news that are happening in the industry, the housing market, anything you can think about. We're going to try to go over. And of course, if you're on this either on Zoom, YouTube, leave any comments. We'll try to get to those as well. But this is going to be a fun-packed 1 hour, so let's go ahead and get to it. All right. So the goal of this YouTube page and also for my business is number one, to help people become debt free through home ownership. That's always my main goal. Is help them purchase a home, and then after they purchase a home, they can use that home to be able to refinance, pay off debts, and then eventually pay off that home, hopefully with a 15-year mortgage, to be able to get to a point where they are debt free. But the what we're going to be going over in this podcast, what we'll be doing on a monthly basis, as we're going to be discussing these mortgage and real estate news that occurred in the last 30 days. This month is Gabriela and myself, but in the coming months, we're going to plan to have some special guests on here too. Some people from our team, loan originators, potentially some real estate agents. We're going to have some guests to be able to go over these different topics with you. That way we can get some other perspectives as well. All right. So to begin this, just tell me something that's been on your mind, Gabriela, in the mortgage industry.
Really,
30 days.
it's what everybody's been talking about is the interest rates. Especially buyers who were hesitant to buy last year, and now they're kind of coming back and realizing, okay, now I can't get that lower interest rate. So, I hear the loan officers are having different, conversations on that, and just in, all the mortgage updates that we're seeing within our own masterminds. Also, we have the advantage of also joining other real estate masterminds, and it's the big topic because it affects the whole industry right now.
Yeah, you are correct. Race is a very big topic. And to be honest with you, I'm actually going to send this presentation to all of my buyers that I'm a loan originator as well. I'm going to help buyers get into homes, refinance, etc. I'm going to send this presentation to all of my buyers because they need to be able to know what's happening with the rates, with the rest of the market, etc. Because if you pre-approved the buyer in December, they've been looking this entire period of time. Once they finally go into contract, their rate has jumped up from an initial quote of 3.5 to now a quote of 4.8, 5.1. It'll be a big difference for them. So thank you for sharing, Gabriela. The main thing that's been on my mind is still, it's a month-to-month thing. It's kind of been my thing over the past couple of years. It's one-time construction, building loans. This is a huge project of mine that is really starting to understand these. There's so many different types of products. The majority of lenders are only dealing with conventional, sometimes FHA, sometimes VA, but broadening the right niche products is very important. And this is one that I think a lot of buyers can be able to utilize and make the process a little bit simpler for them. Yeah. They're able to buy a home or buy a plot of land and build a home all in the same transaction. Put down minimum 3.5, 5% to be able to do this type of transaction. It's something that's very important. So I'll continue on with that, but that's something that on a daily basis is always going through my mind. But good. Let's see what else we got. All right, so rates. I'm going to quickly explain how they work before we get into the chart, because I'm going to actually show a chart to people on Zoom, and I'll describe the chart to the people on Facebook or on YouTube. So there's a couple different ways that the rate works. One of the big ways that it works is going to be the Federal Reserve. They lend money to banks. They set a rate at which those banks can be able to get that money from them. And the higher this rate, the higher all interest rates are going to be. So not just mortgage. It's going to be your car, your personal. It's going to be mainly those because those are going to be your short term. But it does affect mortgages a little bit as well. Right now, it's been at 0% over the past couple of years. They just raised it to 0.25 to 0.5, and they're planning to raise it even more, another percentage to 2 percentage points over the next couple of years. So everyone that has, a loan for anything, expect rates to go up because of what the Fed plans to do. Another way of how rates work is in the mortgage industry. There's something called a mortgage-backed security. Now, don't go on Google, don't go on a deep dive, because 3 hours later you'll be still confused about how these backed securities work. But just in general, someone gets a mortgage, that mortgage company bundles up 100, 1,000, et cetera, these mortgages together, and invests. A set of investors buy it. And the same way you can be able to invest in a certain stock or company, Apple, Google, you can invest in these things. And the more people invest in them, the higher the value is, the lower the rates. The less number of people investing in them, the higher the rates. So let's jump over to the actual rates, and then we'll get some perspectives on it. So these are the rates over the past 6 months, or the mortgage-backed securities over the past 6 months. And for the people on YouTube, it's just a line that is sloping continuously down. It changes on a daily basis. So it's going up, down, up, down, up, down, up, down, up, down. It's doing that all the way down to where we are right now, to where mortgage-backed securities are pretty low in comparison to where rates are now going to be the opposite, which means rates are a lot higher. So that's the difference of about 1.5 to 2 percentage points in the course of about 4 months. And the unfortunate news is that they're not seeing that slowing down. All the experts out there are seeing that to continue to increase over the next 6 months, year, because of inflation. Inflation is very high, and that is the most important thing to the Federal Reserve, who controls all the money in our country, is to get that under control. Gabriela, what do you think about rates, where they're at, this slide, et cetera?
So a couple of things to point out. So when we're looking at the slide, and it starts over back in November, so it's going to be 2021, and you're looking at it from like a higher point index, and that's also about the time when the interest rates for loans to purchase homes, or what were we saying, like what, 2, 3, somewhere around that.
I have locked somebody in at 1.8 at one point in time.
All right, so I was there restricted too.
That was still rare, but it had happened. 1.8 happened 15-year owner refinance, but in general, it was mid-twos for a period of time.
So when we're looking at the chart and we're actually looking at interest rates now, it's kind of like you have to flip the chart around in your mind and look at it.
You do.
So because even though it's showing, the higher points back in November and the interest rates were lower, now as we're looking into, currently in April, it's trended downwards, but the interest rates have gone up. So, when graphs are the most visual, simple things to look at, but you have to understand what you're looking at in the graph as well. So from a consumer standpoint, I would have looked at this as like, okay, well, rates actually should be higher, but you have to, educate the buyer, and also, real estate professionals who are, their job isn't to focus on the rates. Their focus is to help their clients, help their buyers, help their sellers. And this affects very much the market. And so noticing that even in some of the, the internal office chatter and stuff, when we were talking about, oh my God, with this, we just lost these basis points. And, this is just like looks like about a 6-month view of what it's been. So I like the historical data because it always tells a story of where things are headed. And even though things can change from day to day, the general trend is exactly as you were saying. It is trending downwards, but the interest rates are going up. The Fed Reserve has already said that they're going to increase interest rates already. So knowing those things already now from a consumer standpoint, because I like to kind of bring the consumer aspect, for official purposes, I am not a loan originator. So my commentary here is always going to be like, if I am a consumer right now looking to buy a home, this is going to affect me. And so, we're just here to provide some education and knowledge so that buyers and realtors can better prepare for what's to come.
You're correct. One additional point for buyers to understand is understand your why. Why are you trying to get into a home? For a majority of buyers, and I speak to probably, let's say, 10 new buyers every single week around there, there's a couple things that they're mainly thinking about. Only mainly two. One is they want to be able to own a place, and they can be able to change things up. They can, repaint the walls. It can be a place for their family. They can have it for long term. Something that's going to go up in value, because we all know homes continue to go up in value. People think that recession is going to cause it to drop. 7 of the last 8 recessions, home values have gone up, and it's only going down during one recession. That's because the recession was actually caused by bad lending practices.
Yes.
There's not bad lending practices right now. People have a lot of equity in their homes. Actually, the majority of homes are even paid off. People own them free and clear. So recession is not going to potentially lead to tons of homes in the market, foreclosure, things that nature. So homes go up. People want to get that home because they want that long-term future for their family. The second reason is, rents keep going up. Whether it's recession, whether it's not recession, doesn't matter. Rents continue to go up, which means that people don't want to keep paying some landlord to get them more wealthy. They want to be able to own something that they can be able to be paying themselves. And just like with the car loan, the overall goal is not for you to have this loan forever. You're only getting a 30-year mortgage because you're saying to yourself that the monthly payments on a 15 or 20-year mortgage may be too much. But the main goal, like with the car loan, is to have it paid off. The main goal with a mortgage is to have that paid off. So if you're speaking with a good mortgage originator, they're going to give you monthly payment options, 30-year, potentially 15, 20-year. And if it's the right time for you and your family for that long-term play, and also for your potential monthly payments for the market, they're going to only keep going up. So if you want a home, the goal is to get in there right now and keep on playing over the next couple months, 6 months, 12 months, however long it takes to get you into a property.
Yeah. But also even adding, individuals who are currently renting right now and cost of living and rent is increasing, it's not just because the rents are increasing, it's that there is just a general cost of living that is also going up. And so landlords, are accounting for that in their original, already like, okay, we're going to set out a plan to go ahead and increase the rent by a certain percentage. But what we're also seeing is that, they're increasing it so much at a rate that they're pricing people out of even renting homes. I heard from a great podcast that you could be paying 5% interest right now, and that's just a number that I'm throwing out there, or you could be paying 100% of interest to your landlord. So when you look at it that way, it's like, the shock of seeing, okay, the interest rates are going up, but as a renter, you already paid 100% interest to your landlord. So if that's a motivation for renters right now, that is certainly something that should be top of mind. And also how to plan, because renters right now could be renting for various reasons. Short-term living. It's in the desired area. Their employment. There's so many different factors to consider. Not just the fact of owning property, but also that in the long run, you could get priced out of living where you're at. And if you want to stay in a desired area or just somewhere near it, starting the home buying process now at least gives you a roadmap to where you can be. Whether it's, okay, I'm maybe really good 3 months out before I can really afford to buy a home, but you won't know that until you start. So that's really kind of something that you advocate a lot in your classes and in some of the conversations that I've had, the privilege of listening to, is about educating the buyer that sometimes right now, while it may not be financially feasible, but you need to know where and when you will be able to buy.
Yes.
So a lot of factors to consider in that.
Cool. You got it. What else we got?
Oh, I was holding back a little bit when I saw this slide coming up. Not going to lie.
Equity gain in 2021 on average was $55,000 for current homeowners. This slide is broken up by states. So some states have it a little bit higher than others. State of Florida, it was 76,000. Extremely appreciative to live in the state of Florida for that. Georgia, 55K. Where's New York?
Yours is very, very small in the chart, man. We could straighten our
38K. I know. I don't have glasses yet, but we'll see.
I have them, but I still
Yeah, Colorado, 75K. Texas, 45K. California, $117,000. Average increase in equity over the past year. So what do you get from this?
Well, these are averages, so it's always nice to look at, from a national average, perspective. But when we localize things, we're in Hillsborough County, and the number here was, not 55,000. It was a really, yeah, I really wish I could remember what the property values had increased. However, something to kind of take from just in general is that ultimately, I don't know, guess coming back, is that when as having a home as of last year to now, you have essentially put 55,000 into your available pocket.
Yeah.
That is 55,000 just by being a homeowner right now. That all you did was make your payments. We're already in the game in the market and mortgage, and there you go. 55,000 has now just been added as available equity line of credits for home repairs. Some homes haven't been updated in a long time. This is what we're talking about, like the generational wealth and what you could do with the money. Another thing that I've heard is that your home is essentially like a savings account, and to be a good steward of your savings account is what to be able to do when you have that available money. Is it the long-term plans that you've been wanting to achieve that you now have a shorter time because you might have planned this out maybe 10 years in the future, but it's now. The future is now when it comes to mortgages.
Agreed.
Yeah.
Agreed. The future is definitely now. And I'll keep relating this back to cars. In the car world, you're normally either looking at new or you're looking at used. And new is going to be your higher price points, and then used is going to be your lower price points. Well, people, when it comes to homes, they keep saying, "Oh, homes are going up, 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 up. I can't afford to buy a home, etc." Well, the relation to new and used in the home market is in a city versus outside of the city. Inside of the city, home prices are going up, up, up drastically, and those prices will normally be a lot more inside the city. But then outside of the city, maybe depends on where you're at, what ends up becoming rural, an hour, 2 hours, etc. If you're able to work remote, if one of your big goals is to mainly own a home, for example, we live in the Tampa Bay area. So if we're going more towards Ocala, Pasco County, a little further out, etc., you can get homes for a lot cheaper than if you're trying to buy a home in the city. So the main thing to think about is if this being inside the city is where you want to be at, just like most people would like a new car would be the number one item to get. If the monthly payments are not going to work out for you to where it's going to be affordable for you, quote unquote, then you're going to want to go towards a used car. And to me, that's location when it comes to the home market. If being in city is not going to be affordable for you, but you really want to purchase a home, then you really got to start looking at outside the city, in my opinion.
Yeah. And that also kind of goes into what we're talking about with the real estate market in general and the inventory that's available. We have access to data that tells us, how much inventory is currently available, and is that inventory going to be available for a month, 2 months, 3 months? And right now, the average inventory available is about a month. So that means that a home is placed on the market, and generally there's already offers just as soon as it hits it. And real estate agents are also, not only are they representing listing agents, where they represent the sellers, they're also representing buyers. So they may have a listing that's coming up and they already have a good buyer that's like, you know what, I already have a buyer ready for your home. And so it doesn't even give anybody else the competitive edge at that point when the real estate agent can handle both sides of the transaction, because they're looking at both sides. They're looking at their sellers and their best interest, as well as the buyer that's been looking for months to get into a certain area that is desired living. In Tampa, we're fast growing. Some infrastructure is starting to happen. Roads are getting paved, and that's a big thing in Tampa, big thing for commuters. But it certainly makes a difference if you're living in Tampa and you're living, like let's say, in Wesley Chapel. That is a 30 to 45-minute drive, and that's a commute. We're not talking about the stay-at-home, people that are able to work from home. That's a whole different demographic. We're talking about individuals that have to, look outside of their desired area can make a significant difference in price of their home. And also, areas that are up and coming too. Builders are starting to put more into areas that are yet to be developed. Now this more goes into like your side is like, USDA loans, bond loans, and so forth, because of the type of home that they have, may qualify for different type of financing as well. So there's a lot to unpack in everything that I just said, but it goes really go back to, you may want to live in one desired area, but keep an open mind, because home ownership now it isn't like it used to be before. People are generally not keeping their homes for a very long time, but you can purchase a home now and wait it out for a few years and then move on to the next home, unless it's your final, like your what we call your retirement home. You downsize, and this is it. This is what you want to enjoy for the rest of your life. Or if you're a young family or a new family, more than likely you're going to move around, a couple times, especially as kids are getting older and you want to move into a desired area, whether it's for school purposes or work purposes. It goes back to like, what's your why? Why do you want to buy a home? So
you got it. For average first-time buyers, only keeps your home for 3.5 years. Second-time buyers plus, average is 9+ years. So keep that in mind. What else we got? All right. So mortgage rates jumped by at least 1%, 6 times in the last 30 years. So this is trying to dig more into the actual details of what happens when mortgage rates jump this fast. They've done that over the past 4 months. In each case, home values have increased. So you're going to get the news, and people are going to tell you what they think what's happening in the news. You're going to get some real estate agents who very well meaning, but their main job is to be able to, find you homes, show you homes, things of that nature. And some of them are digging into data and numbers, and many of them are not. But this is the actual numbers and data of what is happening when interest rates are going up. Home values have still gone up over these last times they've jumped this much. So in October 1993, they increased about 2.38% in a short amount of time. Home prices went up 3% still. January 1996, the interest rate went up 1.2%. Home prices still went up 2%. 98, same thing happened. 2003, 2005, most recently 2012, interest rates went up 1.11%. Home prices still jumped up 11%. So the correlation is actually with them going up. I'm not going to say it's a causation, but it is a correlation that, hey, if interest rates are going up, home prices are still going up. What do you say about that, Gabriela?
I think it sums it up in a nutshell. The wonderful thing about having historical data in the real estate and mortgage industry is that you can go back and actually look at previous ones. It's sometimes, a good indicator of what's to come. However, when you break it down into what's happening immediately, the announcement today that the interest rates are going to go up. When you focus on just that news, you kind of forget the bigger picture. And that does take a little bit of like a mindset change where it's like, okay, this is what's currently happening now. Historically speaking, in the past, when it has occurred, this is where the trend is. And then that's where decisions need to be made at that point. Inaction is also, unfortunately, it's the bigger price to pay. It's kind of how I view things. If you don't act now, you're going to pay for it later. And so, I love that you put together this data and that you're actually sourcing it from. This is from Freddie Mac. This is from a trusted government source that has accumulated this data since 1993, and we're looking at it from like a short window of about about 30 years here, so that we can kind of see what's been happening. Lots of things have transpired historically speaking, as far as international. We're looking at what's not painted here is like what was going on in the world at that time, and that's something that for me, I love history, so I really do kind of try to remember. All right, what was happening in 1993? Also what was happening in, May of 2000 and, May 2003, 2004. And even right now, international, what we haven't even brought up now in our podcast yet is also about, what is happening internationally in the world. And we are looking at, war, conflict that is happening that is affecting, commodities, also affecting, oil prices. We're not the experts in that. However, that is something that is affecting our market right now. Also, on top of the interest rates going up, on top of inventory being very limited in certain metropolitan and areas, not demographics, but like in high areas. So yeah, this chart says a lot already. When you look at it. So that's a perspective that I try to like to bring in when you show me these charts and data. And also, I look at it from first time. So this is like a real reaction to it. I may have seen some of these charts here and there, but this is where we get to chat about it.
You got it.
Thanks, John.
You're welcome. I'll make one more note about this. You're not going to the news for medical advice. I hope you're not. I hope you have a doctor, some respected person that you're going to for medical advice. Please do not go to the news for what you should do with rates, home information, things of that nature. The point of the news is to be able to get you to watch them. They are entertainment companies. So if you want to know what's happening with rates, if you think something's changing with rates, speak to your mortgage lender that you know and you trust. And as soon as possible, it's going to be a quick, easy text for us to respond back to with those answers. All right, what else we got? Please.
All right.
All right. Initial jobless claims.
We're getting into the nitty-gritty of the economy here a little bit.
Yeah. Initial jobless claims. It's still pretty low right now, but that's the thing that they talk about for recessions, though, is that a recession always comes once unemployment hits its lowest. Because as soon as you see the uptick, they start laying off people. That's normally the cause for recessions to come later. So it's kind of counterintuitive. It's like, yay, go economy right now. There's a lot less people right now that are filing for unemployment. But as soon as we see that turn around, which pretty much almost all of the people are saying, once they see that turnaround, which they think will happen in the next year, recession is going to be coming soon. Anything to say about that?
So let's talk about the generations. This will affect baby boomers. It's a term that many people know, and something that I was watching and trying to dissect as well is that when it came, especially last year, when there was a lot of people that were laid off, or fortunately due to the pandemic, there was a huge job loss there as well. Was that individuals who were still actively working from the baby boomer generation and then the generation afterwards, some of them were just not coming back into the job market. So that, those numbers, while this is like an overall, when we look at, the demographics of certain individual groups, that's also a big factor was that, and that was mentioned, on the news. So, you kind of have to filter certain things from it, but certainly you can't get caught into, the media frenzy of it all. But, it is true that, there are individuals that are just not going back into the job market. I personally have this happening in my current home situation is that my parents are just not, they're retired. They're pretty much retired at this point, so they're not in the job market anymore. And this is actually even before the pandemic and everything had occurred as well. And so now their children, we're in the job market as well. So, while jobless claims are going down, we also have to look at how many people are just not coming back into the job market itself.
Correct.
And, unfortunately, there are still individuals who, maybe they're just not coming back into the job market because They don't have new skill sets to be able to enter into a new industry. There's a lot of layers and factors. I like to peel them like an onion. May not be pretty, but those are things that to consider as well. On a larger scale, this looks good, but when we are dealing with individuals who are looking to purchase homes, not so much on the sell side, we deal only primarily with the buy side. We're seeing, W-2s, we're seeing tax returns, we typically ask for 2 years tax returns on, most loan programs. And, we look at the change in income as well. And that's your expertise right there, is to look at those numbers and to qualify individuals. So, that also affects, the buyer's ability to be able to buy a home if there's been a change in income. After the pandemic, we certainly did see a lot of that as well.
Yes.
Income changes, also having to, get in writing, that individual's going to, had a job, once, they were able to return. And some of those individuals didn't return, had to start a brand new job. And that also affects, your ability to get a mortgage. It's not impossible, but it does affect it as well.
Sure, you got it. All right, let's see what else we got. For single-family homes, the median price is $363,000. For condominiums, the median price is lower at $305,000. My initial take on this is buyers have to continue to increase what they, especially if you're a first-time buyer, you have to really increase your perspective of what you're going to get that first time around. Yes, would it be nice to get the all-American home, white picket fence, like et cetera home your first time around? But if you ask the majority of people who have owned homes, a majority of them have not had the same property for 30 years. They had that property for a few years, and they sold that property, got some equity, paid off some debt, bought a new property with that equity, had that property for a good amount of time, and sold that, got another property. I know myself, I started off in a townhome, which was, like a condo, but it's just homes that are, kind of attached side by side. Not the greatest situation. It was good for me and my family. It was a good starting point, but, you're paying HOAs, and you got neighbors that are right there on top of each other. But it worked out great for us because when we sold that property, we were able to move into the next property, use that equity towards, not only down payment for that home, but move that money around some other places as well. But expectations being lowered to potentially getting a condo first, or in a rural area first, an area that's not in the city, and then progressing your way into finally having that home in your perfect location. To me, that could be the game. What do you think?
I think that's a long-term, play that you kind of set out, as far as like, your own personal story and purchasing, a townhome first, and at that time, because at that time it worked. From, even now, we are seeing more townhomes, condos being built, especially in the state of Florida, because we can't build out, we can only build up. And, there's a new saying that's being thrown around, says you gotta buy dirt, because that is where you're going to build next. And, just because we only look at our current, area that we live in, this is where you're looking outside of the box, looking outside of where you live. And certain factors also to continue, consider with condominiums is that, there's a lot of things that are taken care of for you. You don't have to worry about, maintenance, as far as like the landscaping. Some of them have, features and benefits like pools, gyms, and if that's the kind of sort of lifestyle that you like, that's great, because then you are going to be in there for quite some time. If it's for the short term, then you've got to keep that in your mind that, this is just a short term, and that in 2, 3, 5 years, I have plans to move into something else, just like you did as well, growing family, job changes. But looking at this, as far as like the median price for single property, for single family homes, and then condominiums being at a little bit lower, there's the buying power of condominiums has to be considered with how much they're going to be paying in HOAs or homeowner association fees. That is something that is considered. That is.
It is. And I normally say, let's say it's 300 to 5,000. Let's say HOA is around 250, 300. That's kind of similar to a home that's at 325, 330.
Yeah.
So that's still going to be lower than your single family homes in total.
Yeah.
But from a buyer's mindset of I'm going to get my home with space, yard, and all that type of stuff versus getting a condo, which feels like you're still renting. You're still getting the added bonus of you're paying yourself every single month,
yeah.
Rather than paying this lender this apartment complex 100%.
Yeah.
So.
Yeah, I really liked when I heard that, and I think it's going to stick. And for me, that I can either be paying 5% now, or whatever the current interest rate is, or I could be paying 100%. Our focus is going to be on, let's get you to where you're not paying 100% of interest to somebody else.
I'm gonna get a flyer about that. I'm taking notes. We need a flyer. Pay 5% now, or 100%
to your landlord.
Interest to landlord.
Yeah, it's just a different way of saying, you could be paying yourself, as opposed to paying somebody else. But it stuck, man. That stuck with me this morning when I was listening to that podcast.
We gotta get a flyer on that.
Yeah.
I'm gonna
give a shout out to the Mortgage Chicks on that one, because
that was them.
That was them. Yeah, shout out to the Mortgage. Yeah, they
gotta love them.
Getting ready this morning, I was like, I just need something, kind of get me, ready for our podcast today. And I was like, hey, listen to that. I listened to different ones, and I think this morning it was like, you know what? That has just like, whoo, it clicked. So, but we digress a little bit, and that's my fault too, regarding the, as far as the median prices go. We're still, at the heart of the presentation and what we're doing here, we are still talking about, the benefits of buying now in this market. So I still think it's a great, yeah.
You know what? I gotta subscribe to more research. They're not on my page. I normally get emails about it, but I don't know if I've received the email recently. So I gotta go subscribe to them. That way I can be able to show them some love.
Oh man, I gotta give a shout out to that for sure.
Yeah. All right. State of Florida down payment program now offered $10K as its main program, rather than $7,500. So that's right now. It's going up some. To be honest with you, it's really tough with these down payment assistance programs right now. I'm having an issue with them. There's county programs for down payment programs, there's state programs, and then there's more private programs that don't go off those types of money. And with all these programs, monthly payments are going to be higher, maybe $100 a month, $125 a month, etc. Some other situations as well, but that's the main one buyers got to think about is there's a trade-off. Do you want lower monthly payment? Do you want lower monthly payment but higher cash to close, or do you want higher monthly payment but lower cash to close? And with the way homes are going up in prices right now, 10K I'm seeing it as a good thing, but it's not fully touching that cash to close number. For example, at 300K could be 20K to close. 10K helps you out, but you're still looking at 10, 11K to be able to close. And the county programs, they give you more money, but those county programs will say, hey, on the tax code, it has to say only Tampa. And the tax code, which is a very small portion of the entire Hillsborough County, entire state of Florida, etc. So let's say you get 15,000, 20,000, 30,000, which gives you more money, but you have that, you have additional underwriting, etc. So I like that they're increasing that for that program, which that's the easiest program in the state of Florida. Program we can close over 30 days, but I'm still not sure that's enough. What do you think, Gabriela?
I'm actually just going to leave this with you on that, because I think this is where you're the expert on it. I mean, I'm going to look at it, saying 10K is a heck of a lot better than 7,500, at this time. But all the points that you are making are extremely valid. So, do you want the help now and then but there's trade-offs. There's always going to be a trade-off. You're never going to be 100% balanced. You're either going to take the assistance up front and then pay for it a little bit later, or that's really how you have to look at it. And from a consumers, especially when we get phone calls, like, hey, I found you on the Florida Housing Authority website, and is it that you can help me with down payment? You know, the initial thought in the individual's mind is that they think it's like 100% assistance, and that's not really always the case. Actually, if I'm correct, with the exception of like the VA program, that is actually, the only, and I could be wrong if it's not just the VA program, but this is just a little bit of assistance in the larger scheme of your actual mortgage itself, and what you have to bring to the table. And also many, many, many years ago, I learned this lesson the hard way, from being a first-time home buyer, being excited and, looking like, okay, what's down payment assistance? And, I wasn't really a qualified buyer at that time. However, the individual that we spoke with the second time, she did a really good job actually telling us like what we needed to do. And, that actually kind of changed the mindset of like, okay, gotta focus more on putting some money aside, setting this, fixing credit as well, that, being honest, having to fix my credit and making sure that, my husband's credit, he has a stronger credit of both of us. And, so when we're looking at, down payment assistance, there's still credit factors that have to also be considered as well. It is not to get discouraged. It is actually to start beginning to get educated in the home buying process. Yes, we want you to get assistance if you qualify and it's available. But to also look at it from like, you have to start becoming now just not only just an educated buyer, but a future educated homeowner, because there is a lot of responsibilities that also come with that as well. You're training off the landlord's responsibility to become your own landlord in itself. Remember, you're going to pay yourself as opposed to paying someone else.
Sure, you got it. I'll make one more point about this. Just speak with the lender that deals with these products.
Yeah.
Buyers spend hours and hours and hours on Google websites, etc., trying to figure out about these programs.
Yeah.
Don't do that. Speak with the lender, myself, team, other lenders out there. Just find one that understands these products, that works for them, that can give you the pros and the cons, and figure out what's the best situation for yourself.
Yeah.
All right, what else we got?
And then one of the other things, for FHA, for Housing Authority, we're approved, so that's a big thing. So if you're at least going through that website and you're looking at the list of lenders in there, those are individuals that have been vetted by the Florida Housing Authority. So, that's a good start there, if you're going to look for somebody to get that process started.
Sure. All right, what else? Average tax returns in the U.S., how to use that money in the home buying process. So the national average is around $3,000 you're getting back. Some states are higher than other states, but it looks like across the board it's around $3,000. The main thing, well, first, Gabriela, what do you get from this?
Well, something to consider last year was the child tax credit. Most individuals who had children were eligible to receive, monthly payments, as part of the child tax credit, so they can get money in their pockets right then, and for their immediate needs. However, when you're filing your taxes this year, you also are going to get a nice little letter saying that you did receive this assistance, and that is going to affect your tax return. Now, again, we are not tax professionals. We are not here to, give you the details, because that is not our lane. We are not going to drive in that lane. However, that is something that was important, that affected a lot of families, because that money was used, but it was not just money freely given. It essentially, you're going to have to report that on your taxes, and that is affecting your tax return now. So tax day is Monday the 18th. If you haven't filed already, you need to go ahead and make those extension plans going. And if you have already filed and you notice, wow, my tax refund wasn't as high as it used to be, those are some factors to consider as well. But putting away, some of that money towards buying your next home, making sure that we can source the income, because that's a big thing for us. Is you have to be able to source your funds, and sourcing means that it's been in the bank account for at least 60 days.
Depends on the program. Some do 30 days, but we always tell buyers 60 days.
Yeah, so like no mattress money.
Yep. Yep. A lot of that out there.
Yeah, and again, that goes back to the mindset of money, where it's coming from, and how people save it and use it. It's on a national average, it's not as high as I think we've seen before, but this is still money that you can reinvest back into yourself. And for the purposes of a home buying, this is your leverage point.
Yeah, I tell buyers this: unless you got a financial advisor, as soon as you start working with myself and any other decent lender, I'm not your financial advisor. So anytime you're getting additional money, bonuses, commissions, etc., coming in, before you start throwing that money at different things, because buyers think, oh, I'm pre-approved, but I want to throw money at these credit cards, trying to get a higher credit. They'll start trying to move this money around different places. When in all reality, we can tell you, hey, don't pay on that credit card. You don't need that. Your credit's already good enough to get you the programs you need to get into. Or to be honest with you, some people have the higher tier credit, anything above 740, considered higher tier. So the 760 credit, we don't need you paying anything else, in my opinion. But saving that money, holding on to that money, because as soon as you get into that home, I guarantee you're going to think about wanting to buy this appliance, paint this thing over here, this thing, one little item needs a repair after a couple of months. Like, having cash feels good, and cash overall is key in the process. So as soon as you get that money, whether it's tax returns or anything else, you're speaking with either your financial advisor or your lender if you don't have one, so we can tell you how best to use that money.
Yeah.
Good.
We got it.
There you go.
Out there.
What else we got?
Keep it simple there.
We're almost at the end.
Yeah.
A couple more slides. For sale by owner, record low, 7% compared to 20% 30 years ago. These are people that are selling their homes by themselves. Gabriela.
Oh man. So I'm gonna put on my realtor advocate hat here, because I'm not a realtor. Again, I'm not a realtor, not a loan originator. I don't carry this license. But when you're surrounded and you have a great rapport with a lot of realtors like we do, this is huge. The term is called FSBO in the industry. However, comparing the numbers to record low compared to before, there has been a lot of changes. We're going to focus on Florida, in the Florida contracts for the sale of homes. And, whereas before, individuals probably felt a little bit more comfortable, in handling their own sale transactions, there is a lot of new changes to the contract. And, unfortunately, the seller could lose out more than if they just had worked with a professional real estate agent. And also, how are they going to vet all these offers that are coming to their for their home? I can tell you that even from just my little journey back and forth in my commute, I don't see a lot of for sale by owner signs anymore. They're not there, at least in my neighborhood. I have a very small little neighborhood in central Tampa, and I'm seeing more real estate agents representing home sales. So, I think what is happening, and this is just definitely an opinion, is that, people are becoming a little bit more educated when it comes to the selling of their home properties. They maybe don't want to deal with the hassle because it is a little bit more complicated now in the state of Florida. And also, homes have to be, they have to be eligible as far as if there's financing involved, and we won't go into as far as what type of inspections and everything that the home has to meet. Their 4-point inspections are vital, because the buyer doesn't want to just, especially the buyer who wants to move into that home and live in it. Investors, that's a whole new set of playing ground right there. They have their own rules. They will will pick up these properties and fix them up and flip them and sell them. But even they have to also deal with certain contingencies too. You know, if they purchase a home and flip it, especially if it's a buyer who is an FHA approved buyer, you know, they can't buy a property that's been flipped in less than 90 days. That I do know for a fact, so I can state that, you know, comfortably. But I think this is also kind of all going back to like the inventory as well. So lots of factors to consider, but inventory, not dealing with the hassle, also, you know, just a lot of regulations that have been, you know, put in place. But overall, you know, people maybe are holding out also for better. Lots of factors, but right now the record says it. There's just not that many for sale by owner homes out there. So for us, that could be a good thing, you know, for the buyers and the sellers right now. But we'll see maybe I think in the next 6 months if this is still continuing to trend. I'm going to zoom in on this chart just a little bit because the lowest point was around 2018. If we're looking back in the last few years. And now in 2021, it's about the same level as it was in 2018. So, you know, 2021 and 2018, they're right about the same mark. But the general trend is going down. So.
Yep, good stuff. A couple points to add to you. Putting your home on the market as a for sale by owner is like going to court and trying to represent yourself without a lawyer. So a real estate agent is not a lawyer, but for the amount of training that they have to do to be able to understand the contract and how it works, you might as well consider them as your lawyer throughout this transaction in this process. Yeah. Step one, this is an auction type of game when it comes to buyers purchasing homes. Buyers do not just purchase a home at whatever price you throw out there. The reason why home prices are going up is because real estate agents know how to price homes competitively, and then when that home is priced competitively, that's when you start getting bites from buyers. Where you get 5 bites, 10 bites, 15 bites, etc. Even in this crazy market right now, where there's so many buyers and so few sellers, there are still homes that are sitting on the market, and that's mainly because you have buyers that are putting it on the market for way too high.
Yes.
FSBOs are known for doing that. They're going to overshoot it, the value of their home, and they end up not getting any bites on it. I was listening to a podcast last night that had a very well-known real estate agent in the Florida area. She said she does an agreement when she does listings with her sellers. Yeah. She says, hey, we're going to agree to your price, and if we haven't sold your home within 2 weeks of that price, you're signing this right now that I get to be able to lower your price to be able to get some more buyers in the market. So that's kind of intuitive because agents get paid. The more the home sells for, the more they get paid. Yeah. But their main job is to get your home sold for as much as possible. So they're telling you that they need to lower the price to try to get it sold. And that's what happens with FSBOs. If someone's trying to sell their home, they're not going to have any idea about that. They're not putting the market on the MLS again if you're an agent, which allows thousands of other agents to see the property. Negotiating on the contract, these 20-page contracts. They don't know how to deal with that. Dealing with 15, 20 buyers. There's a lot that goes in. And then once you're in contract for that 30-day period, so many different things happen. Even on the most smooth, easy, supposed to be slam dunk deals, something always comes up, even on cash deals. Anything else for that?
Just 2 points. So, you know, when an individual decides to sell their home, and you said it perfectly, they price it at a higher point. There's an emotional value that they are attaching to their home. Emotional value does not translate to market value. I love telling this joke because my dad actually, he's hilarious when he gets calls and text messages. A lot of solicitors, you know, realtors, I know you guys are doing your job. But we had an individual, you know, who called, and my dad happened to pick up the phone call, and he says, you know, well, what price do you want to sell your home? And I know what our home is worth. And my dad says, $400,000. This is a home that was purchased for $800,000. value of the current home, in its current state, even with some upgrades that are coming as well, doesn't even top 210. But the point that I think my dad was making, and I thought it was actually hilarious when he told that, the realtor that, sorry, realtor, if you're watching this, was that there is an emotional attachment. My dad knew he was throwing an exaggerated number out there. And, of course, the individual on the other line didn't, wasn't able to kind of counter that, rebuttal a little bit. But, thinking, dad, in the mortgage industry, and I also had to have a conversation with him about that. He's like, I'm not selling my home. So really, when I'm being solicited to sell my home, I'm going to give them an outrageous price. But for a real serious person who is trying to sell their home, the emotional value that they place on their home is not realistic. So what that realtor did, for that individual was probably like a reality check. Like, hey, listen, we're gonna go at it your way, because one, the realtor doesn't want to lose that relationship. They don't want to lose that potential sale. They don't get paid until it's closed. But there is a certain reality versus expectation, and a good real estate agent is going to not only advocate for you, but they're going to also tell you the hard truth. If they're just going to people please you into what you want, then they're doing a disservice. That's where competitive market analysis come in, and that's what a real estate agent has the access to as well. Is they can go back and look at the sales of homes in the past 6 months, 1 year, and tell you, Mr. Owner, your home based on the current market in your area isn't really valued at $400,000. It's really valued at $210,000. And I think that would have been a different conversation with my father, but he's not selling your home. Sorry, guys, just letting you know that he's not.
Your father said a joke, but that's not it. I mean, that's what's going to happen when you go to sell your home on your own. Most likely, you're going to overvalue the market.
Yeah.
And you only get one time to put that home on the market for the first time.
Yeah.
I bought a home for a steal a couple of years ago because they initially put it on the market for way too much. And then after a couple of months, they put it down a little bit, but it was still too much. A couple months later, it was still too much. But after a home has sat for 200 days, buyers are thinking, there's got to be something wrong with this home. If every home is selling in 1 to 2 weeks, many times 1 to 2 days, and this home's on the market for 200 days, there's got to be some serious issues. It looks nice, but let's continue on.
That's 3/4 of a year go by.
So you only get that one chance.
Yeah. Well, and then now even going back, and the reason why I thought it was hilarious about the 400,000. There is actually a home near our, where we live. I drive by, every time. I love telling stories about my community because I really, now that I, especially in the last, going on 5 years, when you're working in a real estate, company and now in the mortgage industry, now I'm more aware of what's happening in my community and home life. And so there's this. I've seen this, gentleman every time that I would go by, and he's outside, keeps his house well manicured. There's a nice little pond behind, and then the street behind is a little park area. Cute little home, absolutely adorable. And one day I was like, what? It's been a few months since I've seen this guy. Like, I wonder what's going on. And then I saw moving trucks, and I was like, mind you, this is an older gentleman. I was like, oh no. Well, kind of find out the home was put up for sale not shortly after that. Now, this is last year. Months go by. It has been on the market now for almost 5 months. And I said, I don't understand. We're in a seller's market. Why isn't this home selling? I have no desire to buy it, but, I want to know who's moving into my neighborhood. So I look it up, and going back to the joke my dad said, the house is actually listed for $400,000. Our neighborhood doesn't support that price market. And so I started getting me thinking, I'm like, do they really want to sell this home, or are they just holding on to it? Because it is listed on the MLS. If anybody's asking for the address, I'll share it. But it was just interesting that now a home that is overpriced in my little media market, it's been sitting there for 5 months. So these little gems that are out there, um, it's only a matter of time that they're going to get priced realistically.
Yep. Or they take it off. Let's see what else you got, please.
Yeah.
Lending new mortgage tech company, the one that we mentioned in the last update that fired 3,000 employees, is now offering severance packages to anyone in the company that quits, meaning that they already did the 3,000 layoff a couple months ago, and now they're saying, hey, it's getting tough out here. If you decide to quit, we'll actually give you a severance package to make it nice for you guys. There's another mortgage company in the top 20 out there, and there's hundreds, thousands of
Yeah.
mortgage companies. But this other one has just fired 170 processors and underwriters this month. Uh, what do you think about this, Gabriela?
It's a cause and effect. When you look at it, what is happening in the market, you know, that's the cause. Many factors led to that, and now we're dealing with the effects. And unfortunately, it just sounds like, you know, there's 170 now individuals that are going into the unemployment market. Some of them with severance packages, according to your presentation here. But they previously fired 3,000 individuals. So those numbers do add into unemployment. But there are also individuals who are passionate about this industry and they love what they do. And now they have to go and find another mortgage company to continue doing that, or some of them just may completely change careers altogether. We were looking at, I was listening to a podcast, Contacts to Contracts, with Brian Level and Jon Jones, just about, the changes, how many career changes individuals will tend to have as well. And, this is that moment for these individuals. Are you going to stay in this mortgage industry? We have a lot of individuals that weathered the 2007, 2008 market crash, and they're still in the industry now, because this is what they want to do. This is their career passion. And now these individuals are going to be faced with that same decision. Are they going to stay in the mortgage industry and go somewhere else? Or are they going to enter into a whole new different career change? Because unlike, many decades before, the work ethic was you go to a job, you clock in, you clock out, you work there very hard for 20 years, you get a pension, and then you retire, and then you live your golden retirement age. That's not happening now. We're looking at a whole different retirement outlook for individuals. And that really is what it says to me from, like I said, my perspective is always going to come from maybe a sociological and cultural aspect of things. But when we're looking at this from the industry, is that, mortgage tech company, how long were they in business? Van Dyke has been in business since 1987. The owner literally still has his name on the company. So he stands behind it. And when new companies are being created in the mortgage industry that are not, they're not grounded. There's so many things that I could say about it, but without knowing that the exact company, I'm going to have to speak about this after the podcast because now you've got me piquing my interest.
Yeah.
This is where, who you work for in the mortgage industry makes a huge difference. And, if you're still passionate about doing this, then, there's still opportunities, great opportunities for you. But your mindset has to change because the market has changed. Keller Williams, talks about, pivot the shift. And it's no different than in the mortgage industry. We have to pivot and shift with the changes as well so that we can, continue to grow in what we're doing because the mortgage industry impacts not just individuals' lives, individuals' careers, but the economy. Where we're just a small part of a much larger, piece. And so I just hope that they find their way.
Good. So thanks for adding the human element to that.
I gotta add some heart,
I
because I'm like, oh man, what if that was me?
I know. Well,
Yeah.
now here's the robot perspective.
You're
I am
not
a
the
robot.
robot. You're
Computer. Here's the computer's perspective. Whatever you want to say, this is the give it to you straight guy perspective.
There you go.
So step one, these companies that have done these, this is not going to be the first ones that do this. This is an industry-wide thing. This is what they do. It's happening first. Tech companies, the ones that are new, but one of those companies that's in there has actually been around for a little bit of time now, like 10 plus years. So one thing for buyers and agents to understand, buyers and agents to understand is that these companies staff up during a refinance boom, and then they fire once the refinance boom is over. The refinance boom is over, and so now they're laying off, which means that also the mortgage professionals, they shake up as well.
Yeah.
Their favorite processor doesn't work there anymore. Whatever products and systems that company had, they're not liking that anymore. And in my business, you'll see a mortgage professional, they'll be in the business for 15 years, and they've been with 10 different companies in those 15 different years. Now, I'll tell you this, when you change companies, they end up changing systems, processes, different processors, different underwriters. The way they handle their business is not going to be as organized and structured as it was before. So just keep your head out for it. You may have the communication part is going to be the main game when it comes to who you're working with, whether it's a real estate agent or a buyer. Don't think about rates. All of our rates are very close to the same. Almost every single last product is normally within 0.125. But that communication you're going to get from that loan originator is going to be the most important for your submissive buyer, in my opinion, and for an agent. If you're not getting the communication that you need, let the lender know. And if it doesn't change, there's plenty of us out there. Anything else for that one?
Yeah, I mean, overall, when we're going to talk about maybe like the work culture here in just a second. As you were mentioning, it does take a bit of time for a loan officer to build rapport and a relationship with your processing team. And once you kind of get into like that groove, like you know how each of you work, what to expect from each other, also your strengths and your weaknesses. I'm going to drop SWOT analysis in there for a second there. It does actually help your working relationship. So when things shake that up, such as this company apparently did, that does affect a lot of like the internal processes, and changes in staff tend to happen. So that really is, that's kind of like the unfortunate side of like the work culture at this point, is that seeing that those changes do tend to happen. But it also kind of goes back to how immediate the company is going in there to either make the changes that are going to be better for their company to weather through that change, or if they're getting out of the game and they're changing and they're rebranding and they're going into another new company, because they can, at least sometimes they will. But that's I love who we work with a lot. You learn a lot from them. I feel challenged every day by who I work with, to grow professionally. And anything that changes that, there's an emotional feeling about it. That we have to kind of go back to our purpose and why we're in this business. I am not in my job because of one particular, person per se, but because of, that person maybe led me into this field. But it's what I enjoy about being in this industry. That's kind of like the heart matter again. They're bringing back softness.
Hey, we need it. We need it. Two more. Let's see what we got. Profit for non-bank lenders dropped 44%. Once again, refinances are going out the window. There's companies that only really focus on refinances. And there's companies that focus mainly on purchase, but we also do refinance, of course, as well. I know our company,
Oh, yeah.
we focus on purchase. We try to take care of our real estate agents first, and then refinances, we still take care of them. But that's always in addition to making sure we can get buyers into homes first. There's always a contract and a deadline attached to that. But for many of these banks out there, unfortunately, their profits are dropping, and that's profit, which means that they're probably getting money from these loans, but they may not be handling their money correctly, and so their actual profit is dropping. Anything for that one?
Yeah, so when we're talking about like, the refi boom that, took place even last year and a little bit before that, what was really interesting about it was that the reason it was able to be so successful was because the interest rates were so low. And somebody who had, purchased, even 1 or 2, more years before and had a higher interest rate, with the numbers that we're kind of looking at now. Now, at that time, we're able to refinance at a lower interest rate, shorter term, so they can pay their home off, faster, or also refinance and get some money so they can maybe purchase their second home and become, start building like their own little investment, portfolio. So, our as a company, and at least I'll talk about our team because I know our team numbers are a lot stronger than I do, the company numbers, just in general, is that our business was split between 70% purchases and 30% refinance business. And that's saying that, our focus was always going to be as far as like making sure that the purchase part of it was being taken care of. And also going back and taking care of our clients before and saying, hey, look, now it's a great time to refinance. I can't tell you how many marketing campaigns, how many calls were made, everything that we did to reach out to our past clients to let them know. And there was also, other companies too contacting them as well. And, within our own team, those numbers stayed pretty consistent. We were about 70% purchase, 30% refi, fluctuated maybe like, a few percentage here and there. And then overall as a company, it kind of trended around the same thing. We were higher in purchase, for the year than we were for refinance. So there was still a lot of refinancing opportunities available out there. Now, the non-bank lenders dropping 44%, they just, it was a niche. If you look at it, just as a heading as itself, it's a niche. And that's what they focused on. And so this also kind of goes back to the previous one about, when they fired a lot of individuals, from those companies because, what their product line was for refinances, that started going down for them. And so, without the solvency of other product lines to be able to offer, this is now the effect, cause and effect of, where the mortgage industry currently is. We still say that there's still individuals out there who could benefit from refinancing, whether it's for just maybe a better interest rate or if it's also, to look at their home equity. And, now is still a good time, because of the interest rate to be able to, get some cash out of their property's equity value to make improvements. And if they don't want to go into the buyer's market and buy another property, they can also maybe even look at outside areas to purchase a second home, a retirement home, their future home while renting it out right now. So, yeah, kind of coming at it from all these different angles, what this company did is just one of many, but, we're going to look at it from the bigger picture.
Yep. And this is actually for non-bank lenders as a whole. In our area, I'm not going to name them, but there's plenty of different companies that you see on news, that you see on advertisements, commercials, where they're only doing these refinances because they're very easy to do. And as soon as, refinances fall out, they drop off heavily. But just understand this, people will always purchase, whether it's 2% or 20% the rate. People will always purchase. People should always refinance for a lower term because that's the main way you get rid of interest over time. You can lower your 100K interest, 200K interest. just from going from a 30-year mortgage to a 15 or 20-year, people should always refinance to pay off debts. So you can be able to pay off these 16% interest rate credit cards and other loans to be able to get it all into one. They should always do that. So higher rates mainly affect people that refinance only for rate, which I'm going to tell you this, whether the rate is 5, 6, 7%, that is not the main way that you're able to limit the amount of interest you're paying over the loan. That may save you 10K, 20K, but the way you save interest over the loan is going to a 15 or 20-year mortgage versus a 30-year mortgage. All right, let's see what else we got. Last slide. FHA is thinking about a loan modification. So people that are having issues with paying, making their payments, they're thinking about taking this to where people can be able to talk with them and be able to go to a 40-year mortgage. What do you think about that?
I'm going to go back to the car example that you did. I used to remember when you would buy a car and you would finance it, and your typical terms were anywhere between 3 years to 5 years. The last vehicle that we purchased, and we had to do a 6-year loan, and in my mind I was like, oh my God, 6 years, like, well, it is the car that we wanted, and the terms and everything that kind of fell in line, and that made it happen. But I'd always grew up thinking it was like 5 years, 5 years being the norm, 60 months, all right, you break it down, and then 6 years. I believe I've even seen, and this is, somebody said, yeah, I had got locked in for a 7 year. And I was like, 7 years to buy a car? I was like, the appreciation value of that vehicle just went out the window the minute you drove it off the lot. Now, changing that into the perspective of, for a 40-year mortgage, life expectancy, how long are you keeping that home? The advantages of keeping a 40-year mortgage, there's a lot of questions that need to be asked from the consumer, from the home buyer, homeowner, that you need to ask to make this a decision for you. Unfortunately, delinquency is something that happens. It could be very true whether we're in a great economy or in a bad economy. It doesn't matter. What happens to an individual in their personal finances, loss of second income, loss of, your job, many factors can affect somebody, not being able to pay their mortgage on time. And that does affect your credit. That's one aspect of it. But the personal part of it is like, when you're thinking about making this type of decision, gotta ask a lot of questions. I know I saw this headline. I don't delve into it very much. And I think this is something that we'll need to maybe have a bigger conversation about, later on as well. But yeah, what are your thoughts? Because this is I'm a little shocked just to see it and still kind of hear about it. But that's just because I don't know all the information yet. So once I have more information, then I can come back with a different perspective on it, besides using a car buying example.
Yeah, so step one, whether it's 30-year, 40-year mortgage, etc., you're only getting these longer term mortgages because you're going to have a slightly tougher time yourself personally paying for the lower term mortgages. The goal is always, whether it's within 2 years, 3 years, 5 years, however many years, to refinance if you plan to stay in a property long term, to get to a 15 or a 20-year mortgage. That's always going to be the goal in my opinion. But the main thing I get from this headline, though, is just to always speak with your lender if you have any issues, questions, etc. Step one for buyers, as soon as they start having tough times and maybe they get fired from their job, recession, everyone's saying recession is probably going to happen this year or early next year, and it could get tough for some people. Do not just stop paying on your mortgage payments. Speak with your lender, speak with the person that helped you get into that property from a lending standpoint. They can be able to give you some suggestions on things you can be able to do to modify your loan, because the whole goal is tough times happen, but you never plan to be out of work for 2 years, 3 years, 4 years.
No.
Recession happens, or sometimes happens, you get laid off, look for a job, 2 months, 3 months, 4 months, 6 months. But the goal is to have, let's say if you have own a home, you modify it for a period of time. And then once you get done with that, it gets modified back to another, situation that's going to last for an extended period. But speak with your lender. There's a lot of different ways to help assist you during hard times.
Yeah, I mean, it's true because, we've refinanced vehicles a couple times, different vehicles for many reasons. The interest rate that we got at that time was maybe a little higher. And then, we realized like, oh, we can get a lower interest rate. And then we just had to extend 6 months. Something I even had, encourage my parents to do was like, look, I know that you're getting close to paying off one of your vehicles, but, my personal, story for that is that I have to look at it from, in the event that something changed in your finances where only one person was going to be responsible for paying all these bills, you got to restructure some of your, your debt. And so I did encourage them to refinance, and luckily they were able to refinance, several years back, at 3.875%, which was still lower than what they originally had purchased back in 2002. And then also after that, we're able to refinance one of the vehicles and still have payment on there. It did extend it out for 6 months, but the payment went down $150 as well, so that it made it affordable. Should something happen in their income, that only one person would have to pay all the bills. But shortly after that, within about 7 months, it did actually happen. And because of that financial planning, I'm not a financial planning expert. I'm just their daughter. I just live with them, and we're a multi-generational household. That's a big topic coming up now too. That's being discussed as well as multi-generational living. Is that when we're talking about the baby boomer generation, and adult, children are having their parents move back home in with them. That's another topic that maybe we can discuss at another time, or just you and I have all these wonderful conversations, outside of the podcast as well. So that this can make sense in that term, because this paying your mortgage is a big factor in your credit, but what is personally happening in your life is also the reason why you have to make big financial decisions for the long run as well. So I'm super curious to learn more about this as a consumer.
Yep, vendors don't want you to fail. Vendors want you to pay for the entire time for what you're doing. That's how they get their money. But good. That's all we got today.
That's it.
That's it. Gabriela.
Nice.
Much appreciated.
Yeah.
I love this. Be able to go over these topics, to be able to share out to my clientele, to be able to people on YouTube who randomly stumble on it, so they can be able to watch it and maybe get some updates on what's happening in the market for April. But yeah, that's going to conclude our podcast or class. We're going to have another one, of course, it's monthly in May. I will set it up over the next couple of days, and we will see you then.
Yeah.
Thanks.
Oh, before we sign out, thank you for trusting me to add your commentary to your presentation. It's been exciting, and we got a lot more to come. It's been a lot of changes, so excited. And guest speaker, as soon as we can announce who that individual is going to be, it's going to drop on Jon's Facebook page, and we'll share it out so that you guys know who's coming. Anyone from just even the wonderful people from our team who are very versed and knowledgeable, as well as agents that Jon, you personally have worked with as well. We're ready for it. 2022. We're gonna help you stay connected, and also we're gonna cover all of it. We're gonna touch the facts. We're gonna touch the heart. We're gonna get it done.
There you go. We're changing the name. Facts to heart. See you guys.
Bye guys.